Professor Joseph Nnanna, Chief Economist, Development Bank of Nigeria, joins us from our Abuja studio. Great to have you on the show, sir. Good morning.
Good morning, Laddie. Great to be here.
So we see for the macro picture, GDP growth, real GDP growth for the first quarter of 2026, 3.89%. Q1 2025, GDP growth was about 3.13%. So we're seeing a movement upward there. Non-oil share of GDP was 96%. Manufacturing growth, Q1 2026, about 3.29%. Trade growth, Q1 2026, 2.08%. So the data definitely shows, some kind of rise there when it comes to GDP. And we've seen the market already delivering, massive returns for investors. But there's, it seems to be that just the investors are the ones benefiting, from most of the reforms we've seen so far. The man on the street still complains about affordability, after subsidy removal and all of that, good stuff. But do you think Nigeria has finally moved from economic stabilization to a point where we can actually say maybe we're getting sustainable growth?
Thanks for the question, Laddie. So the short answer is not yet. While we have achieved a greater perspective from a macro stabilization lens, but when you take a look at the macro level indicators, inflation, like you pointed out, has declined from the peaks of the 2024-2025 period. Exchange rate, the Nigerian foreign exchange market has been relatively predictable and stable, albeit still high, at around 1,360, 364 naira to a dollar. Reserves has improved. I think gross reserve stands around 52 billion US dollars, and so on. So at the macro level, the picture is clear that there's a degree of stability. So that's been achieved. However, in terms of when we think about, if you like, sustainable growth, we're speaking to the common man on the street. So what does that look like? From my vantage point, I want to say rising productivity speaks to sustainable growth. If you will, strong private sector investments, job creation at scale, growth in real incomes, because we know currently right now, GDP per capita is not as strong as it needs to be. Also, broad access to finance. That's really where the rubber really meets the road. When we achieve broad access to finance, you begin to see a degree of sustainability going strong there. And of course, let's not forget improvements in infrastructure and human capital development. That is key. Now, in the end, I would say that the GDP currently right now and the economy broadly is basically growing, but it's not inclusive enough. Poverty remains relatively high. Consumer purchasing power is still relatively weak, and public debt service also continues to essentially constrain fiscal space. So by and large, the answer is not yet. I'll pause there for more questions.
All right, so definitely not yet, but when you look at the macros and you look at the politics of things now, we're seeing the likes of a country like Zambia now. Definitely, the macros are looking quite good there after the incumbent he incurred or inherited debt, and the country actually defaulted in debt payments. But he's been able to turn that around. The macros look good. The currency is even strong. I think the best in Africa, currently. But even heading to the polls, he's still quite nervous, at this point, because we still have the people there complaining. They're talking about, cost of living crisis. Right here in Nigeria, also, we've seen stabilization with the currency, inflation, easing. But it seems, do you think that's enough at this point? Or do you think, is it patience, that's needed to see the macro actually, translate, somehow to the micro level? Or can it happen at the same time, good macro numbers and the micro also, good?
That's an interesting perspective. So I think it could happen simultaneously, but it's boiled down to sequencing. However, I think in the end, when you begin to invest enormously in the real economy, when you have policies that are conducive for businesses to continue to invest and hire more people, when you develop your human capital and your workforce broadly, you will begin to see inclusive growth happen. Access to finance typically becomes more important at this juncture. So if you broaden and deepen financial intermediation, for instance, you will begin to see businesses grow. You will start to see businesses hire more people. Productivity will begin to rebound and shoot up. And ultimately, this has a widespread, if you like, prosperity effect. The truth is, private sector credit broadly has increased. However, more needs to be done because ultimately, where is the money actually going to? If it's going to the real economy, for instance, now you will see manufacturing sector, specifically manufacturing sector that does not require inputs from outside of the country. So businesses in the manufacturing sector who actually rely on inputs within the country stand a better chance of growing, quite frankly, much faster than those that require inputs from outside the country, simply because it requires FX hedging, it also requires volatility in the exchange rate, and so on and so forth. But by and large, ultimately, inclusive growth can be achieved with concrete policies that speaks to the common man on the street. Industrial policy, which has taken into effect, and sometimes we have a lag. When some of these policies come on board, it takes some time to filter through the economy and for businesses and individuals to really feel the effect of this said policy. So to answer your question directly, some time is needed. Rome wasn't built in a day, and I can assure you that the policies that have come on board, their reforms, takes time, it is painful, but notwithstanding, it is quite frankly needed in order to set the runway for a takeoff that the economy and the country is going to see in the years to come. So if I were advising investors, the common man on the street, yes, the capital markets are doing well. Opening a brokerage account, investing index funds are okay to start. A safe bet and trusting your government would be to invest in a federal government savings bond. That's another way to go. I would also say treasury bills. But more importantly, I would say the real economy, fast-moving consumer goods. That segment is quite burgeoning. We have a growing population, and these folks provide the much-needed services, food, inputs, and so on that will help support the growth of the economy and feed the population, quite frankly. So if I was the common man on the street, that's where I'll put my money. Now, for high net worth investors, clearly there are a few sectors that you can actually invest in. We have the manufacturing sector, which I've mentioned, agriculture, not necessarily farming, but agro-business, agro-value chain, agro-processing, input distribution, if you like. So those are come top of mind. But in the end, ultimately, if you pivot over to the financial services, fintech space, digital lending, that's another opportunity there as well. If you look at enterprise software, so AI and so on, digital technology and enterprise software development, in my mind, that also becomes quite important for investors that are coming into the country or high net worth individuals within the country right now.
All right, so talking about credits, at this point we did see private sector credits for May 2026 about 81.04 trillion naira. Credits to the government, that was about 40.38 trillion. So we see the private sector getting more than the government when it comes to credit. And despite that, who is getting the credit at this point? You see 81 trillion private sector, government 40 trillion. Liquidity, we see that's up M3 That was 129.21 trillion. And we see, if you put that together with private credit, 81.04 trillion. So we see money supply, we see private credits, side by side there. But despite some of these improving macroeconomic indicators, many businesses still say access to credit is their biggest, obstacle. How do we correct this?
That's a good question, Laddie. So we know that financial intermediation has actually not improved as fast as macroeconomic stability. And a lot of issues surrounding that centers around the high level of interest rates. So interest rates remains high in the country. And when interest rates are high, businesses, micro, small, and medium enterprises are less likely to actually access those credits because it becomes more unprofitable for them, and so on and so forth, because costs of goods manufactured will be much higher and ultimately gets passed down to consumers. The risk perception broadly for SMEs are also high, and that's owing to because banks see these segment of the economy as having more or less the informal, the not enough business or weak business records, if you like, inadequate collateral in which the banks are willing to accept. But in terms of the collateral part, I would like to mention a lot of work has gone into the National Collateral Registry, which is quite useful for micro, small, and medium enterprises, and so on. And movable assets are actually a quite useful introduction into the basket of acceptable collaterals for SMEs. But ultimately, the idea here is because of the prevailing environment, it's difficult for banks to unlend, to deepen the portfolios of the respective banks because of these underlisted issues I've mentioned. Notwithstanding, we can also look at the monetary policy authorities, for example, because the monetary policy rate is at 26.5%, does not necessarily translate to banks reducing, if you will, interest rates to SMEs. And that weak transmission mechanism oftentimes is much felt, and there's always a lag anyway. So even though the MPC meets and they allegedly, if they choose to reduce rates, for example, it doesn't translate to lower interest rates to businesses automatically. There's still a lag effect. So ultimately, I believe with time, we will begin to see improvements of this. However, there are other mechanisms in which banks are now using to ensure access to finance gets to SMEs. There's cash flow lending and so on, just to name an example of what banks are doing. There's alternative credit scoring. So there are different ways to achieve the same objective. And banks have been doing a lot to ensure that SMEs are getting credit. But the reality is this, because they require patient capital or long tenured funds, regrettably, the funding requirement has not really met the MSME needs at this time, because most of the lending currently right now are oftentimes short tenured. So the objective here is to find a middle ground to begin to improve the tenor of loans to SMEs, enabling them to have enough elbow room now to begin to build out their businesses, have better productivity, and so on and so forth.
And Prof, the issue about private patient capital seems to be one that's quite strong. In a country like Nigeria, the credit is expensive, and it's not patient at the same time. I'm wondering, have we gotten to a point where we have to import patient capital?
Well, patient capital can be seen in the economy depending on how well your business model and the business plan is actually appraised by the credit committee of the respective banks. So, for instance, now, if you require a longer tenured funding from a bank, then ultimately you can look for a different structure in which it could be project financed and so on that will require a degree of tenor elongation. Now, there are financial institutions that specialize in ensuring long tenor funding gets out to businesses. Now, over the next 3 to 5 years is what we would like to see ultimately in the economy. That 5-year tenor, 10-year tenor loans becomes quite commonplace. Right now, the average tenor is much less than that, and that is not an effective way for businesses to plan. So if you were to go outside of Nigeria into other developed economies, you see loans at 5, at 10 years, and so on. But because the way the economy is currently structured, it doesn't give the ability to price loans that far out into the future. Again, notwithstanding, it takes a concerted effort between not just the policymakers, but also the private sector actors to basically structure models whereby you have funding available that meets the demand of SMEs, allowing them to essentially be able to plan accordingly and grow their respective businesses. Because ultimately, if they have these fundings, it creates a degree of a multiplier effect that allows prosperity across industries, sectors, and the real economy broadly.
And definitely, we've had so many reforms, coming from, 2023 to 2024, 2025. That's reforms for fiscal reforms. We've had institutional reforms, trade and sectoral deregulation. What do you think is the single biggest reform Nigeria must implement right now to unlock faster economic growth?
That's a good question. There are several reforms that are on board right now. But I would say the industrial policy, I think. That policy in itself is all-encompassing, and it speaks to the real economy. And that was actually a good initiative that came from the Federal Ministry of Industry, Trade, and Investment. And that policy, in my view, is quite robust, and if implemented well enough, we will begin to see gains within the real economy, whether it's in the manufacturing sector and so on and so forth. Because ultimately, growth right now is largely concentrated in a few sectors within the economy. But the Nigerian economy is large enough where other sectors can actually be improved on, can grow, and more individuals can get easier barriers to entry barriers, if you like. So that's what I'll point to right now. But the FX reform is actually quite good, well received, and that needs to be deepened accordingly. But those are the reforms I would think are quite top of mind for right now.
All right, Prof, before I let you go, looking ahead, to 2027, what gives you the greatest confidence and what worries you the most, about Nigeria's economy?
Greatest confidence. I would say the ongoing reforms is quite welcoming. I know it's quite painful, but the truth is we have come from a place where we had low growth and a bit of, if you like, an unstructured economy, if you like. But ultimately now, since the reforms have kicked in the immediate term, it felt very painful. It is still very painful. But at least there's a degree of visibility and line of sight to say, perhaps in another couple of years, we will be seeing the light at the end of the tunnel. However, what gives me confidence right now is the resilience of the businesses, the SMEs out there. They are going through a very daunting period because they have a lower savings propensity, and yet they still continue to battle it out and remain open and look for growth. So those are the two things I believe we should take away from this conversation. MSMEs remain the engine of economic growth, and we need them to continue to grow from nano to micro, macro to small, and so on. Because ultimately, these folks are the people who will ultimately ensure that inclusive growth is actually achieved for the Nigerian economy.
Yeah, see the people craving for inclusivity right now. But thank you so much. I guess that's a good place to anchor it. Professor Joseph Nnanna is the Chief Economist, Development Bank of Nigeria. Thank you for coming on the show and enjoy the rest of your day, sir.
Thank you for having me, Laddie.